The US economy added 147,000 jobs last month. The June data was much higher than expected, in a sign of resilience in the labour market, despite concerns over tariffs. The solid jobs report likely means that a July interest rate cut by the Federal Reserve is now off the table. Let's talk to Matt Maley, who's Chief Market Strategist at Miller Tabak. Good to see you again, Matt. Welcome back. So these are pretty strong job numbers, aren't they? What's behind them?
Well, yeah, they were definitely strong numbers. However, it was kind of interesting to see that the private payroll numbers were actually weaker than expected. So we'll see what happens there, because, you know, with this whole stuff with Doge and the layoffs that have already taken place and will start to trickle into the system, how things will play out after we see that. But there's no question that the overall outlook for the economy, which has been slowing for quite some time, but very gradually. But this number tells you that those who have been worried about it falling out of bed have been wrong.
So we said in the introduction there that this means an interest rate cut is now off the table. Do you agree with that? What do these numbers mean for the Fed?
Yeah, definitely. I think the Fed they have been already, there have been a few Fed members are saying that maybe it would, July might still be on the table. But Chairman Powell had been quite emphatic that it would be very data dependent, that it was, although he wouldn't take it completely off the table, it seemed like it was, very unlikely. And then, of course, this data is going to tell us that it's not likely at all. So those people have been looking for the Fed to, cut rates in a more aggressive fashion and help spur the economy to do better in the second half of the year, are going to have to wait a little bit longer.
And one of those people who does want that, of course, President Trump, he's already called for Jerome Powell to quit early. Do you think this increases the pressure on his position?
Well, it'll increase the pressure that the president tries to put on Chairman Powell, but I don't think it'll increase the actual pressure that takes place. I think Chairman Powell is very committed to finishing his term, and I think he will continue to not talk about this issue and say that he's concentrated on what's going on in the economy and what the Fed will be doing going forward.
One thing affecting the labour market, as well as everything really in the US, are these tariffs. How has the labour market reacted so far to the uncertainty around those?
Well, it hasn't reacted much at all, as we can see from these numbers, and that that does raise some concerns. I mean, one of the biggest things is that the market has been so complacent about everything. I mean, obviously, the things in the Middle East turned out better than we thought, at least for now. But we have all these other issues, whether it be the UK fiscal situation, and of course the tariff issue that you're talking about, and then also the fact that earnings estimates in the U.S. have been going down for most of this year. So I worry that things are a little bit too complacent out there, and the market's priced for perfection.
One thing that has responded well to the jobs numbers, though, are bond yields, but they are worried about Trump's big tax and spending bill, aren't they?
Yeah, I mean, it's interesting because I've been hearing for my whole life basically about how the budget deficit is going to be a big problem in the U.S. and then it never comes to anything. The markets never really react to it. But this year they are starting to react to it. So yes, this could create some problems because it does expand the deficit, and that's why passing this the big beautiful bill is so important to the administration, because they want to be able to offset. They want to make sure that they can offset some of these tariffs.
So positive job numbers on one hand, the market's doing very well, but you sounded a little bit sceptical about the US economic outlook. What's your verdict?
Well, I just think that we have a situation where we still know that the economy is growing, the economy is solid, but it's still, the estimates are still below 2% growth for the second half of the year, and that's very hard to justify further increase in earnings. I mean, we're looking for 7% earnings growth this year, 12% next year. That sounds really good in and by itself, and it would be good if the market was trading at 17 times earnings. But it's trading at almost 23 times 12-month forward earnings. It just makes it tough for the market to go a lot higher from here. I'm not saying the market's going to fall out of bed and we'll see a big correction like we did in April, but I just think that the downside risks are higher than a lot of people are pricing in right now. So I do think keeping a little bit of cash on the sidelines is still a good idea.
Matt, great to talk to you as always. Thank you for coming back on the programme. Matt Maley there from Miller Tabak.